Welcome to this episode of the Hidden Money Podcast. Today, Kevin and I are excited to talk to you about tax planning. Except we get it. We talk tax planning. We say that word all the time, or those words together. What the heck is that? Man, it is one of the most powerful concepts. If you can grasp this, it truly can and should change your life. Kevin, tax planning.
Yes.
It's that time of year.
I know, and it's in our vernacular every day. Like, we got to plan for taxes, tax planning. Like, we're proactive tax planners. But what does that mean? Because we actually talk to somebody and they're like, what am I planning? Am I planning to pay tax? What am I planning?
That's the opposite of tax planning.
You're not planning to pay tax. We need to put a plan in place to save tax, and that can only be done proactively through that calendar year, because once the ball drops on December 31st, your tax planning typically is done. There are some things you can do after the calendar year for that previous tax year, but for the bulk of tax planning, you actually need to be proactive in that year.
Yeah, and this is where our profession, a big area that I think our profession has completely failed, the marketplace, the clients that need CPAs. You talk to most people that work with CPAs. Hey, how often do you talk to your CPA? Well, I do every tax time. When does tax time start? I don't know, around February or March. Sometimes as early as January, he'll be proactive and get out to me. My CPA is proactive because he's reaching out to me in January instead of March, right?
Yeah.
That is not helping you. At that point in time, all you're doing is retroactively figuring out what happened last year and figure out how to file your taxes. If you don't change your facts, you can't change your tax. So that's what tax planning is starting to be. But I agree. We say it all the time. People don't understand our language. We're weird. We're tax people. But that's what tax planning is. Can you offer any better of a definition of it?
Yeah, so I'm a process guy. Instead of offering a definition, I tend to just go to a process. What does it look like? How do I tax plan? So step one is you got to find a CPA who's willing to sit down with you, because a lot of CPAs are just kind of buried in the past. They're worried about filing their prior year clients' tax returns. Yeah. They're buried under paperwork. It's hard for them to step out of that prep process and say, okay, I filed your return back in April, and now it's July, October, November, whenever. I need to reach back out to that client, but then they have another 200 clients to prepare. So they're just in this rat race. So you've got to find a CPA who's able to actually step out of those details and communicate with their client base. Tax law changes. We had one of the biggest tax law changes since 2017.
One of the greatest tax law changes in a long time.
In July of 2025. So we had the One Big Beautiful Bill Act, and if you don't know what that is and you have a CPA, you're being underserved. So that's one diagnosis. But then just reach out to a planner. We like to meet with our clients, me, Mike, our team, on a routine basis. And now costs vary, and we'll get into this in the next episode when we have frequently asked questions, but a routine with your CPA is needed.
You just mentioned two terms. I heard tax preparing or preparation and tax planning. There's a huge difference between those. I would say 95% of the public's experience with CPAs is with tax preparers. I mean, honestly, that's what most people who want to become a CPA and who go through the university and the grad school and take that god-awful test, the CPA exam, which I think should stand for could not pass again. No way I could take that again. Thank God I don't have to. Once you're done, pass it, you're done. But most people that are attracted to it, they just like the safety and the rhythm of, hey, I've got a permanent job here, permanent job security. People need to file their taxes each and every year. That's a necessary evil, unfortunately. Let me just do that as compliance. Speak to them once a year, get that tax return done, move on to the next client, then the next client, and then go see that first client next year when it's tax preparation time. How would you differentiate tax preparation with tax planning? Both are needed.
Yeah.
One adds a ton of value, one doesn't. Talk to me about that.
In my process, the planning is first. Step one, we have to develop and devise a plan, because we need to understand your income situation. What are you interested in investing in? What's your family structure like? I just talked to a client yesterday, recently got married. He's high income earner. She's not making as much. He's making $1 million plus. She's making $150,000. We're looking at ways of filing them separately. They have a prenuptial agreement, and so I might have a basis for this, but we're looking, because we're in a community property state. So instead of having her $150,000 taxed at his bracket of 37%, maybe we can file them separately, and she can put that on her own tax bracket. And so That is what a plan is. You cannot devise that plan just during the prep process. It takes research, it takes intentionality. Typically, planning has to always be first, and then preparation is preparing and executing on the plan. Yes, we have to actually prepare a tax return. That's how you execute a plan. So they have to go in order. If you are preparing and planning simultaneously, you're leaving money on the table.
Yes.
These are two separate engagements. Step one, plan. What are my facts? What can I do differently? How can I restructure? What can I invest in to change my execution of my preparation, so when I prepare my return and I true up with the IRS with how much tax I owe versus how much withholding and estimated taxes I paid, that I'm going to report. But I'm also going to report our tax strategies and savings to reduce your taxable income. So that's kind of the process and difference between the two.
Yeah. So if you are tired of paying so much in tax each and every year, and don't feel alone. Most people are. Most people don't want to deal with taxes. The last thing they want to think about is taxes, and that is hurting them. That is hurting you. Taxes, if you think about them as a potential asset, as a growth multiplier in your portfolio, they can make a world of difference. But if you're only thinking about them and dealing with them at tax time, it's too late to plan at tax time. The year's already passed. You're going to be reporting and paying taxes on whatever your facts were that previous year. But if you think about it ahead of time and just say enough is enough, stop the rat race, stop the definition of insanity, continuing to do the same thing over and over again, expecting a different result. This is on you. This is not on your CPA. This is on you, the income earner. If you're paying too much in tax, you have the power, and only you, to stop that by working with a tax strategist, or go find your own strategies. This is why we offer hidden money. There are tons of strategies. Think about it. Look at the world's richest people. Go look at the Forbes 100 list or 500 list. And try to look at some investigative reporting and see what kind of tax rates they're paying. When there was that famous example, Warren Buffett complained that his secretary was paying a higher tax rate than him. That's true. It's because these wealthy people, these uber rich people, can afford to go hire tons of tax strategists and attorneys and come out and figure out, how do I stop paying from tax? But here's the deal. In America, we have equal protection under the laws. The same tax benefits that Elon Musk can take are available to you, to me, to Kevin.
Yep.
You have the power, so change it now. Now, I get it. This podcast is falling out early November, right? It's a little late to come up with a huge comprehensive plan. But
It's not
is
too
it
late.
too late?
No. There's things you could do well before December 31st. We can educate. We can get things implemented no matter if you're a W-2 earner or if you're self-employed. Those are two different beasts. But if you're self-employed, we might be able to do some creative things inside your company, pay your children. But if you're going to buy a vehicle, typically I don't want to have my people just go buy depreciating assets to save on tax. That makes 0 sense. But maybe if you need to buy one anyway, then we're going to utilize that. So
That's an important point. Don't let your tax tail wag your business or investment dog.
Yeah.
The worst kind of tax strategies are ones where you're just shelling out money to lower your taxes, not to grow your financial portfolio.
Yeah. So to kind of, how do you diagnose if you have a tax planner or a preparer yourself? So where I like to start is when I'm talking to a client is if you have a document exchange relationship with your CPA once a year. Hey, here's my organizer, here's my W-2, here's my charitable donations. You give your CPA the paperwork, and maybe 3 weeks later you get a tax return and an invoice, and then you don't talk to them again for another year. That is a preparer. They are not strategizing. They might be trying to wiggle some things in the preparation process, like, hey, do you have a home office? And you're like, wow, he's going after it. Yeah, I got a home office.
Mileage?
I can get mileage. That is standard. Low-bearing fruit, low-hanging fruit. There's so much more out there that takes intentionality. So that's one thing to look at. If you're one of those people who you may love your CPA, and this is another test that I come across too with people too, is how comfortable are you with your CPA? there's so many people that have such a deep relationship, like, oh, my brother-in-law's my CPA. I've had the same CPA for 30 years.
My family's been working with this guy for generations.
Right? And so when we hear this a lot is, I like my CPA. And I'm like, cool. He likes you too, and he knows your engagement's nice and comfortable. You're not going to push back. And then he's in a routine and not thinking outside the box because he knows what's coming from you every year. They're in a routine. And so there's so many clients I speak to, and they tell me that I'm comfortable, and I could tell your CPA is comfortable. I'm going to kind of put my hand in the soup and stir it up a little bit and make things uncomfortable because you're missing out on some opportunities. So I see that a lot.
Absolutely. So that's how you diagnose the difference between, are you getting preparation and only preparation, or are you getting some planning? I mean, some CPAs, some preparers, good ones, and there are a lot of good tax preparers out there. We're not knocking tax preparation. That's needed.
No, we do it too.
Yeah, it's needed. It's needed. But good preparers will say, hey, when we've done your taxes, you might want to do this differently. You might want to do that differently when they're just looking at your last year's taxes. Have you thought about setting up an S Corp? Have you thought about setting up a self-employed pension plan instead of an IRA? Have you thought about bunching your charitable deductions, things like that? We see those. That happens all the time. But again, that's not tax planning. That's offering reasonable tax advice, but that's not tax planning, right?
Yeah.
I mean, it's starting it, but how can you expand on that?
So I would say tax planning is a way that we're going to be massively reducing our taxes. What you said is very true, and we do that stuff every day. So there are some things you want to just tally up these small wins to get a bigger win, right? Like home office, paying my kids, auto, all these things that you can, honestly, you can go to ChatGPT these days. You can say, give me the top 10 tax strategies. Boom, you're going to have them. You may not know how to implement them, but I can guarantee you CPAs, a good CPA, and a CPA doesn't necessarily mean they're good, but they will be able to enact those top 10 strategies. That is, like you said, good solid tax advice. Planning is, I have $500,000 W-2, and we cut his income in half. You don't do that with a home office. You can't with a W-2. You can't buy a vehicle, pay your children if you have a W-2. That's not tax planning. You can't even tax plan with that. Most CPAs, when they get a W-2, what's the response we get when we hear that all the time?
Sorry, if you're a W-2 employee, there's nothing you can do to lower your taxes substantially.
Yeah. Did you max out your 401k? Yes, I did. Kudos, you're done.
If your CPA tells you that and you're a high earner W-2 taxpayer, go find a tax strategist. You can keep your CPA to be the preparer, although that's risky, but go find a strategist. There are so many things you can do. Every single taxpayer that pays a lot in tax can save a ton in tax, but it takes strategy, it takes planning. Again, it takes changing your facts.
Paying more tax than you're legally obligated to pay is a crime. And here at Revo Taxpayer Advocacy, we are here to fight for you. We want to make sure that you don't pay that dollar more in tax than you're legally obligated. Mike and I want to meet with you personally. And if you go to our website, revotaxpayer.com, and you click the button, schedule a consultation, we want to offer a free consultation for you where we talk about your situation and get to know you, and then we can advise the best next step. So it doesn't matter what's happened in the past. You can change your facts today and have a better tax outcome in the future. So revotaxpayer.com, we'd love to hear from you. All right, back to the episode. So for like the self-employed people, we have an actual plan internally, and it's intellectual property that we've developed that we walk everything from beginning to end of being self-employed. Structuring, ordinary necessary expenses, retirement. I mean, we go through everything, everything possible, Augusta Rule and all that stuff, the ChatGPT stuff. But you need to know that stuff and know how to implement it, because all those little things do add up, but that's one piece of the puzzle. So once we get our business, if you're self-employed, once you get your business optimized, and we've done everything we can, the structure, the expenses, we're funneling as much through, you still are going to have net income left. That net income is going to be taxed to you personally. So then this is kind of where I really start to see tax planning take off, and give us some examples of kind of what you see. So once we maximize the business,
then it's time to start having fun. I mean, maximizing the business or making it most efficient for tax purposes, that's a layup. You should always do that. And it's sad that we see a lot of people not doing it. Once you've done that, again, individuals are the one that pay most of the tax. Small businesses are owned by individuals. Most of them pass through their tax liabilities to the owners on their personal individual tax return. Now what can you do? So much. What Kevin and I are huge fans of is we're just like you. We've built a business. It took everything we had and a decade of all of our finances to do it. Now I'm in my 50s, Kevin's in his 40s, we got young children. We're trying to grow a nest egg so that we can have some financial freedom. That's where it gets fun, because there are investments out there that, in reality, the IRS is subsidizing you to make them if you make them and you apply tax strategy to it. So you could go buy some Coca-Cola stock in your 401k. That's great. You should. You should have a diversified portfolio. The IRS is not going to give you a deduction to go buy it. I mean, I guess in the 401k, they're giving you pre-tax money to buy your Coca-Cola money, but most of the times you're going to pay tax when you take it out. You can go buy investments like a rental property or in a syndication or oil and gas, and you do it right with the right structure. The IRS is helping you pay for 10% of that investment, 30% of that investment. In some cases, 100% of the output of cash can come from the IRS reduction in tax or refund. You can do that. And so not only are you repurposing your taxes instead of just going down the drain with the IRS, you're taking those taxes, repurposing them into your portfolio to grow your financial freedom, to grow your portfolio and have more freedom to do what you want when you're in your older age. That's the plan.
Yeah.
That's the whole key concept that we are in love. There's plenty of things you can do to save tax that ain't going to make you wealthier. There's plenty of things you can do to save tax that's not going to grow your personal freedom.
Yeah.
You got to combine them both.
Yeah, and I like your example of Coca-Cola stock, and I use this example a lot. Go, if you have not seen our oil and gas episode, posted probably a month or two ago, go check that out. Because oil and gas, so like if you were to buy, let's say not in a 401k account, but let's say you're going to buy just in a brokerage account some Tesla stock. You think Tesla's a good buy right now, you want to buy and hold it. Let's say you buy $100,000 of Tesla.
It's a great buy, by the way.
It is a good buy.
Best stock I ever bought.
And when you buy that stock of $100,000 of shares of Tesla, you're not going to write that $100,000 off. That is your basis in the stock. And you calculate your gain or loss on whenever you sell Tesla, the fair market value sales price at that date minus your basis equals your gain. In oil and gas, you get to write off your initial investment. There's ROI, there's an exit, and there's also tax benefits on the ROI period when you're receiving your cash back.
What do you mean write off your investment?
Write off. That's a good question too. So everyone, they want to know what a write-off is. A write-off is just simply recognizing you have an expense and you're going to put it on your tax return to reduce your taxable income. That's a write-off. So if, for instance, you have $500,000 W-2 and you put $100,000 into an oil and gas operation, you're probably going to write off $80,000 of the $100,000 or $75,000, somewhere in there, 75 to 80%. So that is a write-off. So your $500,000 income now goes to $420,000 or $425,000.
Which means your tax went down because your tax is what you pay. It's a tax rate, a blended rate based on how much you pay or how much income you make multiplied by your income, whatever that percentage is. And by doing something like this, not only did you just lower your tax, you lowered your tax bracket. So now you're paying a lower tax rate on the rest of your income.
Yep.
But think about it, and it just, when I can't remember when this really hit me, and I don't think it was more than about 15 years ago. When someone does that, they have a $100,000 investment in oil and gas, and in reality, the IRS just paid for $30,000 of that investment. So they got a $100,000 investment with $70,000 out of their pocket, and repurposed $30,000 they were going to pay to the IRS into their financial portfolio, and they get the gains on that portfolio if it's a good investment.
Yeah. Yeah, so this is something you can implement before year end.
Yes.
This is, we have so much content out there about active and passive income. This is a passive investment in oil and gas, but it's active losses. And it's one of those unique things where you get to write off your initial investment. The government funds some of your investment with tax breaks.
So if I'm a W-2 taxpayer, my CPA said, I can't really do anything after maxing my 401k or IRA, you're telling me in November, heck, even in December this year, I can invest in oil and gas, reduce my W-2 income on my tax return, let the IRS help subsidize my investment in this new area of investments. You hear that? And it's not just oil and gas. Yes, I would much rather work with you. We would all, us tax advisors, us actual tax strategists, would love to work with you starting in January. And there's so many tools in the shed we can pull out and make work for you based on your personal situation. But November is not too late to act. Early December is not too late to act. Christmas, it's probably almost too late to act.
We're probably on vacation, good luck.
But even if you're listening to this over Christmas break this year, okay, you're baked in this year. You're going to do what you're going to pay what you're going to pay. Hopefully, whoever's preparing your taxes will help optimize your situation you handed them. You've got next year to plan. Get on board. But if it's November and you're listening to this, plan now. Do something to change your tax today, and then next year, change it a heck of a lot more. It will change your life.
Yeah. And one other cool thing that I like about planning, and it's almost like it's not gaming the system, but it's almost the way that the Internal Revenue Code is written is they typically phase out high income earners from college credits, from child tax credits, dependent care credits, all these credits that the government actually, and a credit is something the government is paying the taxpayer for just because they're in a certain situation. They have children and they're working, and the government will help pay for your child care with the credit.
If you don't make too much money.
If you don't make too much money. We actually have people making $1 million plus, and with tax planning, we're getting them under the phase-out range of all these credits. So they're able to take, back then, an EV credit. They're eligible for all sorts of like FAFSA. If you have kids going to college, your income, your tax return, you might be making $1 million. Your tax return is going to show that you could be almost making nothing on paper if you're tax planning. And then you're eligible for all those credits too. So there's so much benefit with actually being intentional depending on your situation. Yeah, we're saving some income tax, but there's actually credits the government could be paying you because you're under a certain tax bracket or certain income range that normally you're phased out of. So that is what tax planning is in a nutshell. It is making sure I'm being proactive. I'm sitting down today in this calendar year before December 31st, and I'm going to devise a plan. I'm going to move some money into some specific areas to invest in or to grow my net worth so that I can, when April comes around, I'm going to file my tax return. I'm going to see a little bit of movement on my tax return to where I'm not paying the government so much. Instead, the government might be paying me. I could take those savings or those credits. I can then reinvest them into more things to plan for the next year. So
man.
Snowball.
You're preaching to the choir here. Please join that choir. It is not too late to change your tax. It is not too late to take advantage of the opportunities that are there, and mainly being taken by the billionaires and multimillionaires. Take what's rightfully yours back. It's yours. Don't just give it away. It's not too late. Watch the rest of our episodes this month as we focus on tax planning. Learn more about it. If you don't want to work with us, work with somebody. Please take these episodes and show them to your CPA. Change your facts and change your tax. Let it be an amazing tool in your assets.